In this edition of Talk Mortgage to Me, I brought back in my friend Christine Wilson with the mortgage firm. She's a producing branch manager who has helped over 2,000 families obtain financing for their home purchases. And she has a really cool situation that she's going to walk us through, one in which she helped not one, but two different home buyers purchase properties, and both home buyers came to her thinking they had to put 20% down in order to buy a home. And that's just not the case. And quite honestly, even if someone has 20% to put down, it's not necessarily always what's best for them financially. Mm-hmm. So Chris, walk us through the first buyer that comes to mind that you've recently helped, who thought that he or she had to put 20% down. You ended up being able to educate them that they didn't. What did that situation sound like? What did that transaction look like?
So he was he had been divorced for a couple of years, had a great job, but it was kind of wasn't cash heavy. Okay. You know, just out of a divorce, he was, but he still had his 401k, still had a big chunk of money in his 401k. And so he came to me and he said, I'm going to take the money. I'm going to take 20% out of my 401k. And I was like, and he's like. Which
you can borrow against your 401k. Well, at least most 401ks allow people to borrow against them to use for down payment and closing costs.
Yes.
But you were like,
Well, and it also depends on the age.
Yes.
For me, when I think about, I'm all for borrowing against your 401k. I did it when I bought my first house. But it depends on your age. Once you get past like 40 into the 50 range, I kind of like, that money is for your retirement. Yeah. That money is not for saving up for a house. Mm-hmm. So this guy was he was in his 50s and he was wanting to take 20% out of his 401k. And I was like, have you talked to your financial advisor? I said, because I don't think he or she is going to be a big fan of this. And he was like, nope, that's what I want to do. They come to you with the 20%ers that want to avoid mortgage insurance. They think mortgage insurance is like the evil of all evilness.
I have a neighbor that reminds me of this guy, and my neighbor's a great guy. He makes really good money, but he's a DIYer, right? Do it yourself. Yeah. He wants to do everything himself. I'm like, well, hey, there are like professionals who actually have done this, I don't know, 2,000 and 3,000 times throughout their career. Yeah. You've maybe done it once or twice throughout your career, and maybe there's other perspectives and points of view.
Yes.
So you have a 50-year-old who just went through a divorce, right? So I'm sure that wasn't a fun event, both emotionally and financially. Mm-hmm. So a lot of his liquidity was probably wiped out. Mm-hmm. Still had his 401k, so that was preserved. But this guy's been out of college for 20 years, 30 years. He's making good money. What do you think he's making? $150, $200 around there?
Like $150.
Yeah. So probably making $150,000, $200,000. If you're in Orlando, Florida, he's probably an engineer, more making that type of money. Mm-hmm. And at which point, yes, he knows, right? I know what I'm doing. But what were you able to show him?
Well, I just showed them options. You show them, they come in ablazing with the 20%. But if you show them that the mortgage insurance is really not the root of all evil, it is the savior. It allows you, because guess what? Cash is still king and will always be king. And so keeping cash in your bank accounts is the smart thing to do. It's not, us loan originators, it's not that we want the loan amount to be bigger. We don't want you to, it's just that we want you to be financially sound after you do this, because once you put this money into the real estate bank account vault with a very humongous door, and it's very tough to get that money back out of real estate. It's not cash anymore. Now it's in this real estate vault that you have to either get a home equity line of credit to get that money out if you can qualify, if you're able to, or do a cash out refinance again if you're able to, if you have the equity in,
or sell your property,
or sell it,
which could take 6 months, and then also cost you $30,000 or $40,000.
Correct. Yes, and real estate fees. So it's so important to consider pulling money back if you can afford the payment. Now, some people don't want that payment. They want to put down the money because of it. But I think also, too, they don't realize that when they keep, another $25,000 to $30,000 in the bank, how that makes you feel psychologically.
It's called the sleep good at night factor.
Yes.
Like, I sleep good at night knowing I have 30 grand in my savings account. Yes.
And you make great decisions when you have money in the bank. And when you don't have money in the bank, you make desperate decisions.
So let's look at this guy's scenario. Roundabout, what was his purchase price?
Oh, he was like because he was just trying to get into house, and I think he was like $350.
Cool.
Yeah.
So $350,000, right? And this guy's probably newly single.
Yeah.
Based on where he was in life, maybe his kids, if he had kids, were out of the house. So for him, finding a 3-bedroom, 2-bath townhome was probably the perfect size home for him. So he could find that in Central Florida for $350 grand.
Yep.
20% would have been $70,000 plus another 10 grand for closing costs. So he would have been out of pocket roughly 80 grand. What did he end up putting down?
10%.
He put down 10%. So he put down $35,000. So instead of out of pocket being 80, now he's out of pocket closer to, I'm guessing, somewhere around 43,000.
Yep.
What was the difference in payment between the 10% down payment and the 20% down payment? And then how much did mortgage insurance add to it?
Yeah, I think his mortgage insurance was only like, because if you have great credit scores and your debt to income ratio is pretty decent, then the mortgage insurance can be really affordable. And I think it was like, I don't know, it was like 50, 60 bucks.
Yep.
It was really not that much money. And so once he saw that he was able to not, and 401ks are making, average usually right now around
8 to 10%. Yeah.
And so when I showed him, hey, if your 401k is making 8%, let's just call it 7 on a bad day. Let's call it 7, and the interest rate's at 6. Then why are we pulling so much money out of this? And I think he just really, it was a light bulb moment for him going, oh yeah, why am I doing that? It's just these old things, these stories that we've been told on how evil mortgage insurance is. And it's not that evil. It actually allows you, it's a tool that allows you to keep your money in your bank account and have that sleep good at night feeling.
Yeah, because by him putting down 10% instead of 20% on a $350,000 property, you're probably looking at about $200 in principal and interest, right? His payment was $200 higher. But this is somebody who makes $150, $160 a year, didn't have a whole lot of debt, so he wasn't overly payment sensitive.
No.
The MI added another 50 or 60.
Yeah.
So yeah, what makes more sense? Keeping that $35,000 in your 401k working for you. By the way, that money compounds, right?
Right.
So it's 7% on $35,000 this year, but it's 7% on $38,000 next year. It's 7% on $43,000 the year after. Whereas people might not understand this, your mortgage payment, right? We know this as professionals, it's an amortized payment. So that means you have more principal being paid off next year, more principal paid off the year after. It's almost working in reverse of the compound interest. It's like, yes, why not leverage when you can leverage, especially when it makes the most financial sense? And I promise you, as somebody who like Chris, worked 20 plus years in production, the extra $300 a month that I would make by you borrowing more, the extra $300 in commission I would make because of you borrowing more, that's not what I'm doing this for. I'm doing this because it's what's right. And if I do what's right, the odds of you referring me go up. The odds of you coming back to me for another home loan go up. That's what business I'm in. I'm in the business of referrals, not how do I squeeze an extra $300 in commission out of this person. You said you had another scenario that was similar where you leveraged mortgage insurance because it was the right move, where maybe the person coming to you thought they had to put 20% down. Do you remember those details?
Well, I just know I just had a review. It was like this long on our website, and it was just a
Google review or a Zillow review?
Well, it was Experience, which is what we use, and I think it went to Google. But anyhow, and it was really interesting because I actually got this referral from Reddit. I have a Reddit thread out there.
Good for you.
Oh my gosh,
you've made it.
It is amazing. I mean, man, I don't communicate on Reddit. I'm not on there very often, but man, do people believe in this Reddit thread? And it's unsolicited. And so you can't force that. But anyhow, they came off of there. Again, we just went through with them, is a younger couple, first time home buyers, went through all the scenarios, super detail oriented individuals. And so when I have those individuals, it's even more important to make sure that they have all the data in order to process, because they want it all. They want all the data. So we just went through all of they ended up putting 15% down instead of 20% down. That was just their choice. And it worked out well. And they were just so happy, and they were very just at ease. And one of the things that you just said that made me think is, no, I don't want you to call me 6 months from now and ask me for a home equity line of credit. I don't want to do business with you again for another year or 2 or 3 or 5.
Yeah.
I don't want to do business. I want to put you in a loan that you feel great in for the next 3 to 5 years. Refer me your friends and family, but no, I don't want to do business with you unless you're going to move or do something else that was uninspected. But I want to put you in something that you feel comfortable in for a long time.
Yeah, it sounds like that scenario was a perfect case example where someone could have put 20% down, but if they did, then they would be what I call house poor, meaning they don't have any money left over, right?
Oh.
There's no emergency fund. There's nothing to pay for new furniture. There's now they're really sacrificing.
Yes.
Where you can show them, even on a $600,000 purchase, that 5% is $30,000. Oh, no, it's not $30,000. That 5% is $15,000. Right? But how do you sleep better at night? Knowing you have 15 grand in your bank account, or knowing that your monthly payment is $100 less per month? For most of us, I'll speak for myself here, I sleep better knowing I have that extra 15 grand in my bank account. The $100 a month, I guess if I couldn't make that payment, I can go to my bank account.
Right.
Right? 15 plus, 100 times.
Yes.
Right? I could keep going and going and going in order to get money out if I couldn't. How many months is that? How many years is that?
Not to mention, we make more money as we go along.
Yes. Well, correct. Yeah. Our money is growing
Yeah.
when it's sitting in that investment account. And then more importantly, with putting 15% down, you're paying the cheapest mortgage insurance. So
very inexpensive.
So where your divorced 50-year-old engineer may have been paying $60, this person may be paying literally $30.
Yeah, it was like $38.
$30 in mortgage insurance.
Yeah.
And lastly, y'all, for conventional loans, you can get your mortgage insurance removed. Right? Do a year or 2 of making on-time payments. Let your home go up in value. Pay down your principal. Reach out to your servicer. It is very possible to have your mortgage insurance removed, at which point that extra money you were paying, whether it's $30 a month or $70 a month, even that was temporary. Chris, thank you for sharing these 2 examples with us, and more importantly, educating our TLOP audience. If people want to get a hold of you, what's the best way to reach you?
I would just Google me at Christine Wilson at the mortgage firm. I typically come right up, and all my information's there, and a call to the office or email.
Perfect. Christine Wilson, branch manager, producing branch manager, Central Florida market for the mortgage firm, licensed though in many states. Check her out, reach out to her. If you sound like someone who thinks 20% is needed for down payment, but you ain't got it, guess what? Christine can show you ways to buy homes with little to no money down.